All right, ready to dive in. Today, we're tackling a set of documents that you, our wonderful listeners, specifically flagged for us.
Yeah, these look pretty interesting.
They all revolve around, well, a very specific corner of financial reporting, and it gets, well, kind of complex.
You're not kidding.
We're talking about IFRS 14.
Regulatory deferral accounts.
That's the one. We've got all the official IFRS foundation materials, of course.
We've also got some really useful supplementary notes from BDO. Always appreciate their insights.
Absolutely. And let's not forget the feedback from IFRS. Got to have that European perspective.
Oh, and they even threw in the Hong Kong-specific version, HKFRS 14. Makes you wonder how much variation is out there.
Right. So our mission, should we choose to accept it, is to really unpack what all this tells us about, well, a tricky accounting problem.
And it's a problem faced by any industry where a regulator steps in and sets the prices.
Think utilities. You know, your gas, electricity, that sort of thing.
Essential services, often with limited competition, and that's where the accounting fun begins, right?
Exactly. Because then you've got this tension. How do you balance, rock-solid accounting principles with the real-world economics of a sector where the prices are, well, essentially dictated?
It's a fascinating dilemma, and at the very heart of this whole puzzle, you've got these things called, the documents keep mentioning them, regulatory deferral account balances.
That's right. So in plain English, what are we even talking about?
Stripped down, they're expenses or income items, things that under normal accounting wouldn't be assets or liabilities.
Okay, so what makes them so special in these rate-regulated industries? Why do they get, a different set of rules?
It all boils down to, the rate regulation itself. You've got this governing body, right?
Yeah.
They come in and say, this is the price you can charge for your goods or services. And as we said, often it's for those essential services where you don't have a ton of competition. Now, because the regulator considers or is expected to consider certain costs or revenues when setting future rates, these items get deferred.
Deferred, meaning?
It's a timing mismatch. The cost might be incurred or the revenue earned now, but it doesn't actually impact the prices customers pay, what the regulator sets until later.
So the accounting is trying to sort of look ahead and reflect those future regulatory decisions. That's interesting. Now, if I remember correctly, this isn't exactly a brand new issue, right? The U.S. accounting standards have been dealing with this for quite a while.
You're spot on. What's really interesting here is that U.S. GAAP has recognized the economic impact of rate regulation for decades, going all the way back to the 1960s. And they formalized it with SFAS 71 back in 1982.
Wow, so a while ago.
Yeah, and in a lot of other parts of the world where there weren't specific rules, companies often looked to the U.S. approach. And these regulatory deferral accounts, they'd often end up categorized within property, plant, and equipment, sometimes as separate items on the balance sheet.
So the U.S. had a well-trodden path. What about IFRS? Do they just, follow suit?
Not quite. So fast forward to the mid-2000s, and the IFRS Interpretations Committee, they start getting questions. People asking, can we just apply that U.S. approach under IFRS?
Makes sense to ask, right?
Sure, but after a lot of thought, they concluded that the way SFAS 71 recognized things, it didn't really line up with how IFRS works, the core principles.
Interesting. So a clear difference of opinion there. So why did the IASB eventually decide to tackle this whole issue? It must have been pretty important to get their attention.
It was. So in 2008, another request came in, people still wanting clarity. And this time, the IASB added a project on rate-regulated activities to their agenda. They even released an exposure draft in 2009, putting their ideas out there.
So progress.
Well, the responses they got really highlighted some fundamental disagreements. People had very different views on what these regulatory deferral accounts actually represented from an accounting point of view. It was a real conceptual sticking point. And, the project stalled. They had to suspend it.
So a roadblock.
Yeah.
So how did we get from there to IFRS 14? It seems like a step forward.
It was. The IASB realized that this lack of clear guidance was a huge problem for some entities switching over to IFRS, especially those who were already using regulatory deferral accounts under their old accounting standards.
Right, so we had a system that worked, and then...
Exactly. So in late 2012, they decided on an interim solution, a temporary bridge. That's IFRS 14. It let these first-time adopters stick with their existing practices while the IASB worked on a more comprehensive, long-term solution.
So IFRS 14. It's like a placeholder.
Yeah.
Temporary fix. But who exactly gets to use it? It's not a free-for-all, right?
You got it. It's specifically for entities adopting IFRS for the very first time, and only if they were already recognizing these regulatory deferral accounts under their old GAAP. They essentially get a pass, an exemption from the usual rule in IS8, which says you got to be consistent with your accounting policies.
So it's like, okay, we know this is tricky, so if you're already doing this, keep doing it for now.
Exactly, but, and this is important, if you're already using IFRS and not recognizing these balances, IFRS 14 doesn't change that. You can't suddenly start using it.
Gotcha. So a very targeted allowance. Now, something that struck me, the standard uses this very specific phrase, regulatory deferral account balances. Why not just call them assets or liabilities? Seems simpler.
That wording, it's deliberate. There's still a lot of debate about whether these things truly meet the definitions of assets or liabilities under the IASB's conceptual framework.
Oh, so it's like they don't really fit neatly into either box.
Right, so they use this neutral term. It acknowledges that uncertainty. And actually, that's one of the key issues the ongoing comprehensive project is trying to figure out. What are these things?
So the name itself reflects this unsolved puzzle. That's clever. Now, even if companies can keep using their old ways to recognize these balances, IFRS 14 does get very specific about how they present them in their financial statements. Can you walk us through that?
Absolutely. So while recognition and measurement might follow the previous GAAP, the presentation, that's where IFRS 14 gets prescriptive.
Lay down the law.
Exactly. You have to present the total of all debit balances and the total of all credit balances for these accounts separately. And they have to be distinct line items on the statement of financial position. No more hiding them within other categories.
No more blending in?
Nope. The goal is transparency. And the same goes for changes in these balances during the reporting period. They need to be presented separately in the profit or loss statement and other comprehensive income.
So users can clearly see the impact of rate regulation.
Exactly. And IFRS 14 even provides examples of how this presentation should look in practice.
Handy. Now, what about companies trying to game the system? Could a company that wasn't recognizing these balances before suddenly switch their accounting policies under IFRS 14 to start doing so?
That's a sharp question. IFRS 14 closes that loophole. You can't change accounting policies just to start recognizing these balances. Any change has to result in financial statements that are more relevant and no less reliable, or vice versa. And of course, it has to follow the rules in IAS 8.
So no sneaky moves.
Nope. It's about consistency, not creating new opportunities for recognition.
Makes sense. Now, how does IFRS 14 fit in with other IFRS standards? Does it just exist in its own little bubble?
Not at all. Even with the allowance to continue using previous GAAP, other standards still apply. For example, if a company has rate-regulated activities in a foreign country, IAS 21, which deals with foreign exchange rates, will determine how they translate those balances.
So currency fluctuations still need to be accounted for. What about things like earnings per share?
Great point. Companies using IFRS 14 have to present additional earnings per share figures. These figures exclude the net movement in regulatory deferral accounts. And, importantly, they have to be presented with the same level of prominence as the regular EPS figures.
So a more normalized view of earnings without the regulatory adjustments.
Precisely. And then you have business combinations. Under IFRS 3, if an acquirer using IFRS 14 buys a company, they continue using their own previous GAAP for any regulatory deferral accounts they acquire.
Consistency within the group.
Right.
Yeah.
And the basis for conclusions clarifies that if the acquirer doesn't recognize these accounts under IFRS 14 and they buy a company that does, they can't start recognizing those acquired balances. The acquirer's policy wins.
Interesting. So consistent policies are key across the board. Consolidated statements, IFRS 10, investments in associates, IAS at 28, even when you lose control of a subsidiary, IFRS 12. IFRS 14 really touches a lot of areas. Now, beyond just the numbers, what about disclosure? What kind of information do companies have to provide about these balances?
Disclosure is huge in IFRS 14. The idea is to give users enough information to understand the company's rate-regulated activities, the risks involved, and how it all affects their financial performance.
So painting a complete picture.
Exactly. They have to describe the rate-regulated activities, explain the rate-setting process, and identify the rate regulator. And they need to disclose any related party relationships with the regulator.
Transparency is key.
Absolutely. They also have to explain how future recovery or reversal of these balances might be affected by risks and uncertainties, like changes in demand, future regulatory changes, market risks, that kind of thing.
So not just a snapshot, but a look ahead too.
Right. And they usually have to provide a table reconciling the movements in these accounts. It shows how they've changed over time.
Very comprehensive. Now, let's talk about why the ISFB issued IFRS 14 in the first place. The basis for conclusions document, it sheds some light on their thinking,
Right.
especially since it's just an interim standard.
Yes, it does. One of the main reasons was to make the transition to IFRS smoother for first-time adopters. They didn't want companies to have to suddenly de-recognize balances they'd been accounting for legitimately under their old standards.
So a practical consideration.
Right. It was also seen as a way to encourage wider adoption of IFRS, which, in theory, improves comparability globally.
Even if it meant some temporary inconsistencies.
Exactly. But, and this is important, there were dissenting opinions within the IASB. Not everyone agreed with issuing IFRS 14.
That's interesting. What were their concerns?
Well, some were worried about comparability. They argued that allowing continued use of previous GAAP would create inconsistencies within IFRS. They were also worried about setting a precedent for using these sorts of interim solutions whenever a big project ran into trouble.
So a slippery slope argument.
Yeah. And some fundamentally disagreed with the recognition of these balances. They argued that not all of them meet the definitions of assets or liabilities under the conceptual framework.
A clash of principles.
Right. They felt that IFRS 14 was giving too much weight to the goals of regulators, potentially at the expense of fair financial reporting.
So a very fundamental debate about the nature of these accounts and their place in the financial statements. Now, we've mentioned that IFRS 14 is temporary. What's the latest on the IASB's comprehensive project on rate-regulated activities? Any idea when we might see a more permanent solution?
The IASB is still actively working on that. They're gathering feedback from all over, including from national standard setters and companies. They're looking at different accounting models and wrestling with that core question, do these balances really fit the definitions of assets and liabilities?
Tough question.
It is. And the feedback from EFRAG, for instance, they stress the importance of having a rate-setting framework that establishes enforceable rights and obligations, and they lean towards a revenue-based approach, though they do see a potential role for cost deferral in certain situations.
So lots of different viewpoints to consider.
Absolutely. It's a work in progress.
So what does all this mean for our listeners? We've gone through a lot of detail.
It's been a deep dive, but I think IFRS 14 really highlights the complexity of financial reporting in regulated industries. It shows how standard setters try to balance principles with practical realities. And these regulatory deferral accounts, they really highlight the unique challenges that rate regulation can create for accounting.
And the fact that IFRS 14 is an interim standard shows that this is an area that's still evolving.
Exactly. And those dissenting opinions. They're a reminder that there are still fundamental disagreements about these accounts and how they should be treated. It's a nuanced area, lots of debate, even among the experts.
Definitely food for thought. What might the future hold for utility companies and other regulated entities?
That's the million-dollar question. Will we get clearer definitions of regulatory assets and liabilities under IFRS? And how will that impact comparability?
Big questions.
Huge. It's a development worth watching.
Absolutely. For now, IFRS 14 provides a framework. Temporary though it may be, it lets certain companies keep doing what they were doing, but with more transparency.
And that's a good reminder that accounting standards, they're not set in stone. They change, they adapt, they respond to new challenges.
It's a dynamic field. So we've just scratched the surface here. But hopefully this deep dive has given you a better understanding of IFRS 14 and this fascinating corner of accounting.
And what really got you thinking? What other questions do you have about accounting for rate-regulated activities? We'd love to hear your thoughts. Keep exploring those source materials. And remember, accounting, it's not just about numbers. It's about telling a story. And sometimes that story is pretty complicated.
And on that note, we'll wrap things up. Thanks for joining us on this deep dive.
Until next time.
Bye for now.